My name is Rob Lauzon. For those who don't know me, I'm Chief Investment Officer at Middlefield, and pleased to have Vern D with Enbridge joining us today. Vern's, been at Enbridge in multiple scope and multiple roles over his close to 3 decades at the firm, and currently is Chief Financial Officer, Executive Vice President of Corporate Development, and a new title this year, President of New Energy Technologies. So thanks for joining us, Vern, and glad to have you presenting with us today. Generally, today we're just going to ask some fireside chat questions, and I guess the goal here today is to get everyone in the audience here comfortable with our views and on the energy infrastructure, the build-out that's happening in North America, why it's key to both energy security and our growing economy here in Canada and North America. And in addition, excited about Enbridge and its role over the next couple decades in energy transition. And Middlefield, we're an asset manager, we're equity income focused, and Enbridge is really a poster child for how we look at companies. So we love dividend payers. They help us create income funds that many of you own. And another key feature that Enbridge has is its 28 years of growing its dividend. And we love dividend growers. And it's across energy infrastructure, it's across our healthcare, real estate funds. So Enbridge is really a poster child of how we run our funds at Middlefield. And I'll just forward to a slide here that highlights some of our funds. Income Plus, our diversified fund, that one of its top holdings is in Enbridge. And about 5 years ago, in fact, we launched a fund specific to our views on Enbridge, which is our E-split split share. Which many of you may own either the preferred or the capital. And we've just recently launched a global energy transition mutual fund, which again, Enbridge is a core holding in. So why don't I start with Canada, and we've got 2 major projects close to being finished in our infrastructure landscape here in Canada. One will be our first LNG project, LNG Canada, off the West Coast. And the second is the expansion of Trans Mountain. The first should be done in 2025, liquefying gas and moving it to Asia. And Trans Mountain is proposed to be ready and flowing oil to the west for export in 2024. So, Vern, my question to you is, this should increase ancillary activity in Western Canada, good for volumes. Maybe just talk to us about how these 2 projects benefit Enbridge, how you're going to benefit from the growth, and is there any challenges, any competition with these type of projects?
Sure, thanks, Rob. I think both of these projects are going to be beneficial to Canada, Western Canada, and the upstream producing community. Really, we've got a world-class resource in Canada, both on the gas side and obviously the oil sands. And the issue we've been running into as an industry for many years is just enough takeaway capacity, enough egress to get that product to market. The demand for natural gas and oil continues to grow globally. It's likely to decline a little bit in North America as we transition over time, but global demand is growing for the foreseeable future. Like, I think we've been talking about that, when is oil going to peak? Oil is back up above where we were in 2019, so pre-COVID. We've seen growth there, and we expect that to continue to grow globally. And then natural gas is obviously a very key energy transition fuel, where the globe's desire for more power is just nonstop, and Canadian LNG can be a big part of that growth. I think Coastal GasLink and LNG Canada are really critical to the gas business in Canada. Getting that LNG to global markets will increase netbacks for producers. It'll enhance more drilling, and hopefully it will lead to further LNG facilities. I think 10 years ago we talked about having multiple LNG facilities in Canada. Hopefully we'll have our first here, but we've definitely fallen behind the US, who will have 7 or 8 running by the time we have 1 running. So a lot to do there. On the oil side, Canada has been predominantly sending all of our crude oil to the US market for decades. TMX provides an opportunity for Canada to diversify to more global markets. But we're doing some of that already today. You're seeing Canadian crude go the long way down to Houston through the Enbridge system and then being exported, but this will provide another conduit for exports. Competition-wise, I think LNG Canada and Coastal GasLink are actually good for Enbridge, because Enbridge's T-North system in Northeast BC is the feeder pipeline will be the feeder pipeline to all LNG exports from Canada. You would have seen last year we announced a $500 million expansion of the T-North system. We expect to have another follow-on expansion come to market later this year. So we're going to see some good investment opportunity as LNG continues to go up. On the oil side, I think TMX is in the near term a little bit of competition for the Enbridge mainline. We do think that there'll be a very modest decline on the volumes we move through to the U.S. Midwest and the U.S. Gulf Coast. Maybe that's 5% of the volumes that we move for a short period of time. But this incremental egress will allow producers to invest more in expansions, and we expect our pipeline to be back 100% full later in the decade. So I think both of these projects will be good for Canada as a whole.
That's good to hear. When I came away from your investor day a few weeks back in Toronto, I got excited about just simple things you can do organically on your gas infrastructure in the U.S. for LNG, and even more expansion projects and build-out. So maybe just talk about, we talked about LNG in Canada, but really it seemed to me your real growth opportunity, and there is more BCFs leaving North America through the U.S., is the U.S. LNG. So maybe talk to the investors here and us about how that benefits you over the next decade.
Yeah, I think we're known as an oil pipeline company, but we are one of the largest natural gas pipeline companies in North America. We move 20% of all the natural gas in North America. We have significant pipelines on the U.S. Gulf Coast and flowing north there to the U.S. Northeast, and then we have a bidirectional pipeline that flows gas from the Marcellus back down to the U.S. Gulf Coast as well. Today we service 4 up and running LNG facilities, and we provide basically the gas for 20% of U.S. LNG exports. We've got commitments from 3 other LNG facilities once they go to FID that will build incremental pipelines for them to get that gas to market as well. So if you think that LNG is a very significant opportunity for Canada, it's probably a 5 or 10-fold bigger opportunity in the U.S. The expectation is the U.S. is already the largest LNG supplier in the world, and that the amount of LNG that they are going to provide for the rest of the world is going to grow by at least 100% and perhaps up to 300% over the next 10 years. So those will provide very significant investment opportunities for U.S. Gulf Coast pipeline companies. Our Texas Eastern pipeline is connected and will be connected to pretty much every LNG facility in the U.S., as we're one of the few pipelines that hugs the entire Louisiana, Texas coastline all the way down to Mexico. So we're extremely excited about the amount of capital we'll be able to deploy, And as we deploy more capital into these low-risk commercial projects, we'll be able to generate more cash flow and obviously then grow our dividend as we put this capital to work.
Let's touch on oil and just how you plan on expanding and exporting, and how do you export oil outside of North America? It's tough to build new pipelines, so I think you did talk about the expansion of oil at your investor day. I guess having pipes in the ground currently makes your company, in our opinion, more valuable because they're very hard to get built these days. So maybe just expand on your liquid side of your business.
Sure.
Yeah.
I think you're absolutely right. Building a new greenfield oil pipeline is not going to happen in North America, with the exception of perhaps Texas and Oklahoma. So our system, we really have two systems, oil pipeline system. Our Canadian mainline, which delivers about 3 million barrels a day of crude oil into the U.S. That goes into first the Chicago market, then it moves its way south from Chicago to Cushing, to Houston, and then we have access to 4 or 5 million barrels a day of refining capacity on the U.S. Gulf Coast. We also operate the largest system in the Permian Basin. We now move 2 million barrels a day of Permian crude to Corpus Christi and Houston. And pretty much every light barrel coming out of the Permian these days ends up being exported because the U.S. has an abundance of light crude. We, in 2021, bought the Ingleside terminal in Corpus Christi. It's the only VLCC-capable deepwater dock in the United States. It's the cheapest export facility for our customers. And today we're exporting over 1.2 million barrels a day of U.S. crude, which represents about 25% of total U.S. exports out of that facility. That facility has the ability to grow. We have permits to grow it to at least 2 million barrels a day of export capacity. And as production ramps up in the Permian, we'll see more capital being invested to get more pipelines to Corpus Christi, get more storage facilities on the dock, which will allow us then to export more crude out of the U.S. So if you think about it, North America is a major energy exporter now. That's really changed over the last 10 years, where we're exporting significant amounts of natural gas and crude oil. And our whole business strategy over the last 5 years or so is developing those export conduits. So off the Gulf Coast, we're exporting 20%. We're providing service to export 20% of the natural gas, and now 25% of the oil. So we think those are regions where you can still build infrastructure in a reasonable time frame, and we can get that energy to global markets.
Yeah, I guess in a reasonable time frame, Europe has shown if you cut the red tape, look how quick they got the reverse LNG stuff moving during the last year, right? So things can move if you've got everyone on side. Speaking about regulations, I guess in Canada here, we just had our budget, so we had some more capital put towards the energy transition. Investment tax credits increased for clean electricity, for clean hydrogen, manufacturing. There's been some reports recently. I was at a conference yesterday. There was kind of a debate of whether they did enough on carbon capture. So maybe a two-part question. One, do you think Canada has done enough or needs to do more to attract capital back to Canada away from the U.S.? The U.S. just did an Inflation Reduction Act, which essentially was a lot of red carpet towards the things I just spoke about. Europe has done a lot and may do more this year. So do you think we've done enough here in Canada? Do we need to do more? And then secondly, across the U.S. and Canada with our new tax credits and the IRA down there, what areas benefit Enbridge the most, and where are you pushing your new technologies?
Great. I think the way I'd kind of tackle this is the U.S. came out with the most aggressive, tax reform on encouraging energy transition investments. They've offered very significant investment tax credits. They've offered production tax credits. They've put in place what's something called the alternative minimum tax, which is supposed to pay for this. But if you invest in energy transition investments, you can go below that alternative minimum tax. So really they put into, in effect, a tax and credit regime that highly incents people to invest in renewable power, to invest in hydrogen, renewable natural gas, and carbon capture. In Canada, we have a similar tax regime, but it's not as aggressive. And with respect to carbon capture, the U.S. is offering a very visible price for each ton of carbon that you sequester. Whereas in Canada, it's a little less clear what actually is going to happen if you sequester a ton of carbon. So with all that, the U.S. has leapfrogged Canada on energy transition. The U.S. is ahead of Europe as well. And you're seeing large pools of capital move to the U.S. So as a global company, when we're looking at investment decisions, it really does skew investments to go to the U.S. just because there's more certainty and better returns. I think Canada can do more, and hopefully they will do more, because I do think without some of these certainty on carbon capture in particular, Canada won't meet its climate change goals for 2030 in particular. I think we want to reduce total emissions in this country by 300 megatons per year, and carbon capture and sequestration by itself can provide a third of that, but no one's going to make any large capital investments until there's more certainty on that. We're seeing in the U.S. very strong corporate demand for clean energy, whether it's renewable power, whether it's renewable gas. And I think this week we announced a blue ammonia facility that will provide clean ammonia to be used to produce fertilizer in Europe. I think it's very instructive that you're seeing all these announcements in the U.S. When you're not seeing that many in Canada. So we have a little bit of work to do, but I think there's a way to come back from this for sure.
How do you look at ROI on investments for the division, we'll call it your new technology division, versus your base business? Like, is there a ROI that can be achieved? What's your general hurdle rate on those type of decisions? Because as investors that like your dividends, I think everything needs to have some profit behind it. Now, whether it's the tax credits help, but what guidance have you given the street on your project hurdles for that division?
Sure. We are agnostic on technology, business line when we prioritize projects. We only have $5 to $6 billion of investment capacity a year that we're able to deploy towards new growth without having to issue equity, and we don't want to issue any equity. So we have a multitude of businesses that will compete for that capital. And so these new energy technology projects are going to have to compete against conventional energy projects for a scarce amount of capital. So we will look at each and every individual project to look at what does the commercial structure look like, who's the counterparty that's paying us for the service, what kind of risks are involved in whether with permitting or construction, and we'll come up with an individual hurdle rate for a project. Then the projects that generate the biggest spread over an individual hurdle rate will be the ones that get greenlit to go forward. So as the president of New Energy Technology, I'm going to have to bring forward projects that are competitive on an economic basis with conventional energy projects. I think some of the advantages that we'll have in new energy is there are a lot of customers out there looking to decarbonize. They're the same industrial customers that we deal with in conventional energy who understand that we need to make a fair return to invest a lot of capital for them to reduce their emissions. And then we do also have these incremental tax benefits that we can attribute to these projects as well.
Going to the dividend specifically, a lot of investors in this room love getting those quarterly checks, and they love that they grow. And especially now with inflation moving up, having a growing dividend helps you protect against your costs and your own daily life. So what have you guided the street generally? What's your policy? Do you continue to want to grow that dividend and make that a priority for shareholders?
For sure. Growing our dividend is a key part of our investment proposition. So as you mentioned before, we've grown it for 28 straight years. We for sure will continue to grow it in the future. I think you'll see our dividend grow up to the rate that we're growing our cash flow. I think what we talked about our investor day a couple weeks ago was about on average this company is going to grow at around 5% a year. And we see that growing at that rate for the foreseeable future. And the dividend can grow up to 5% per year if we choose to let it grow at that rate. When we're seeing good value, when people appreciate the current dividend, well, perhaps we'll grow it a little faster. If we're seeing a higher yield on our stock, we'll probably grow it a little bit slower because we don't think we're getting full value for the current dividend.
Right. Yeah, with the pullback in the market recently, just over the last 18 months, your yield is close to 7%, which, I don't think anyone's expecting you to have an 8 or 9% yield. So that's probably one reason you grew it at 3% and 3% last year. It makes sense. With the war in Ukraine, it's kind of brought energy security to light. I think a lot of investors that shunned energy came back, and maybe just generalists. I'm just wondering, when you travel across the world, when you see investors, the US, Europe, are you seeing new institutions come into your stock that may have gated you before because you were touching a hydrocarbon, and now they kind of opened up and realized that, looked at your business plan and realized, that they're more amicable to invest in energy? So have you seen new investors? Yeah.
Yeah, like I think in 2020, I think the S&P energy weighting got down to 2% of the S&P when it was historically in this, I think 7 or 8%. I know that it's up somewhere around 5 or 6% now. We're seeing the same story, obviously, with Enbridge. We're in 2020, 2021, all of our questions that we got as a management team were ESG related or energy transition related. Since the war in Ukraine, we've seen a much better dynamic where there's balance now between climate change, energy affordability, and energy reliability and security. So I think as we go forward, as a society, it's important that we do provide the energy that people need to live their daily lives. We need to do it in an affordable fashion so there isn't energy poverty globally. But we also have to tackle climate change. So it's the balance of trying to do all those things together that will drive investment opportunity and cash flow growth for us. So I'm quite excited. We're seeing much more interest in U.S. investors. And we're also seeing European investment interest, which we haven't seen in several years.
Yeah, we run a fund for UK investors that invest in Canadian stocks. So when Dean and I go over there to market, one part of our fund that they really takes up a lot of our conversation is the pipeline sector, because there's not publicly traded pipelines in Europe. So it's something that Canada has in our market and North America that European investors can't get over there.